My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Ed Clissold, chief strategist, Ned Davis Research. Ed, introduce yourself here to the audience. Who are you? What's your background? How'd you get involved in interested in markets? And what are you doing, Ned Davis?
So I've been doing this about 25 years, mostly on the strategy side. And I was a client of Ned Davis Research early in my career. And this is the late 90s when everyone said, stocks just go up and it's a new paradigm. And this Ned Davis guy was saying, well, maybe this isn't how it always goes. And then when the bubble burst, NDR kept going strong. And I thought, they seem like smart people, good people to work with. So after business school, I contacted him, and I've been working here for a little over 20 years, and we've been a strategist for them for about the last dozen or so, focusing on the U.S. stock market, stocks versus bond asset allocation, but mostly equity themes. Where's the S&P going? Your focus tilts towards high beta, small cap, large cap growth versus value, quality, those sort of things. And we have a team that looks at sectors as well. But for those of you not as familiar with Ned Davis Research, we tend to be very quantitative in nature. We're not a quant shop per se, but we feel like we take a lot of good data and try to distill with historical analysis or on software program to analyze the data that can then provide good information to people. A lot of times there are some biases out there that isn't actually how markets have worked in the past. We feel like we can share that with people, and our clients scam they run the gamut, anywhere from private wealth funds, sovereign wealth funds, family offices, long onlys, to wealth advisors. Pretty much anyone interested in how the markets actually work.
I think it's fair to say that being a strategist for maybe a decade plus arguably has been challenging in that it was very hard to make a case for most things except just the S&P, because that was really the only game in town. I'm curious your take on if an era of higher interest rates makes, in some ways, your job easier, more fun, because it might mean that momentum gets spread around to more than just large caps.
I think there's something to be said for that. And I would say, say compared to 15 years ago, what we would run into is somebody would say, well, I'm a fundamental stock picker. I don't care about the macro. We don't get that much anymore. Even people who are fundamental stock pickers, they go, well, I have to know about the macro. So the Fed has maybe been an advertisement for macro investing. So once we end zero interest rates, I do think it could be an era for stock picking again. Whereas, hey, you just, now you, as you said, you just buy stocks, and momentum stocks tend to work. Now maybe doing some kicking the tires and figuring out which company, is doing a better job at their fundamental business may matter more. But I do agree with you though, that once you actually put a price on money, it's going to change behavior quite a bit in a lot of ways. And I do think there will be opportunities to find winners. There's always a bull market somewhere, and it may not just be in the S&P 500, and it may change more rapidly than it has in the past too. So it probably puts more of a premium on maybe making some tactical decisions rather than set it and forget it. Like, and with the benefit of hindsight, that it probably was the best thing to do from 2009 to 2021.
How much of that is driven by sector dynamics? I mean, the reality is, and we'll talk about the regional bank fallout, but when we think about large caps kind of dominating the field, we're largely talking about tech as the driver of that against a lot of other sectors, whereas small caps are not as tech oriented. Sector wise, are more value in terms of their makeup. How much of the dynamic going forward is going to be driven more by just choosing sectors outside of tech to outperform headline averages?
Yeah, well, I think the way I tend to think about this is the way if you're in a slow growth environment where the Fed is keeping rates low and the potential GDP growth is low, the kind of stocks that are going to do well are ones that don't need the economy to do well. They're levered to things besides economic growth. So would you want to be in an industrial company that needs economy to grow quickly? Probably not. Would you want to be in a financial company that depends on a steep yield curve? Probably not. Would you want to be in a company that's maybe innovating, creating new products that people need / want to have, regardless of what the economy is doing? Yeah, I probably would want to do that. And then also with low interest rates, if you say you're a company that creates positive cash flow and then wants to use that money to buy back stock, or maybe even just borrow at next to nothing and buy back your own stock, sure, that sounds great. And what are those? What that kind of leads you to large cap, mega cap. We call it fan mag stocks. People call it FANG. Other people have other terms for it, but I think we kind of know what we're talking about here. A fairly small number of really really big names. So yeah, I think once you change that dynamic, I think one aspect is that with the reshoring of manufacturing, I think the U.S. economy is still going to be largely consumer based. Don't get me wrong, but you're going to tilt the scale just a little bit towards more manufacturing, but probably add some cyclicality to the economy, and that would tend to favor maybe cyclical value sectors like energy, industrials, materials, and then also I think as you said, the small cap sector wise are a little bit different than large cap, so you probably get a little bias there. And I'll just add one more aspect to it on small caps. Look, if you're a company and you're growing, you've gotten to the point where you think, well, maybe I want to go public. Do you want to go public? I deal with the quarterly targets and all the regulations. Well, before that was kind of your best bet. Now the private equity firm are just funding through debt. Debt's at a lower cost of capital. So why not stay private longer? Maybe you can do great and you get some unicorn valuation. You grow quickly and then you go public. Eventually, at that point, you're no longer a small cap. You're a mid cap or maybe even a large cap. And so the reason people buy small caps, the reason Fama and French said back in the day, buy low market cap stocks, is you're getting the sweet part of their growth cycle. Well, the last 11, 12, 14 years, you haven't gotten that because companies have stayed private until they've passed that part of the cycle. Now, with rates higher, private equity firms probably going to want better valuations. The cost of debt is going to be higher. So maybe it makes sense to go public earlier, and maybe you can find some companies at the sweet part of their cycle, their corporate life cycle, in the small cap space. It's a possibility. These are probably there's going to be one offs here, but some of these things really were working against owning small caps as kind of an asset class, and so maybe this will be a little bit better for them.
I have to. I'm always blown away when I look at the ratio of the Russell 2000 index against the S&P. You're back to 1990 levels, meaning
Yeah.
right? If you were in 1990 sitting there saying, you know what, I'm going to invest for my grandchildren, right, and go into small caps because they're the driver of the U.S. economy. It's smaller businesses and more tied to the domestic consumer than multinational large caps. You had the same performance from 1990 to today, but with a hell of a lot more volatility, which flies very much in the face of a lot of those studies around kind of a small cap premium effect, and a lot of that outperformance of small caps really started getting undone late 2014. That's when the fangs in general started getting almost all of the momentum. Now, where I want to go with that is a discussion around breadth. So I shared at the top of the nest a tweet that you put out around breadth. I think a lot of people, and you probably agree with me, get breadth wrong in the way they think about breadth. Obviously, there's a lot more small cap names than large cap names, but lay out for the audience, how do you think about market breadth, and how does the concentration of momentum around just a few stocks compared to history? I mean, presumably there's always a Pareto principle aspect to what drives indices.
Well, yeah, I think when you're talking about market breadth, you want to distinguish between relative and absolute. And that is, the strongest moves tend to start with a lot of stocks moving together. And then if a few of those companies run into trouble, you still have other stocks trending higher. And that's why really good breadth measures tend to be bullish. Whereas if you have very narrow leadership, poor breadth, then those few stocks that are carrying the indices higher, they run into trouble and you're not left with anything. But what sometimes happens is people confuse the relative with the absolute, and so that's what this table here shows, where people say, for example, you take a year and say, oh well, only 3 or 4 stocks are responsible for most of the gains in the S&P or the Nasdaq. Well, that's just how a cap weighted index works. I use the NDX 100, which is what the Qs trade off of. So it's a 100 largest non-financial companies that trade on the Nasdaq. And we looked at years when it was up pretty well, between 10 and 25%, because this year, at least when I did the study, it's up 19. So it's kind of makes sense to look at that range. So, well, how many stocks did it take to get to 50% of returns? Take the company that has the highest attribution returns. Okay, that counted for just example. Let's say that was 20%. Next one was 15. So you just kind of keep accumulating it down. And this year you got to 4 stocks. And I said, well, that feels really narrow. But on average, it's 3. And that's cap weighted indices. The largest stocks drive the indices in a given year. A few of them are up pretty well, and they're your returns. Particularly when you're talking about an index with, this is 100 stocks, S&P. Obviously 500, well, actually a little more than 500 stocks in the S&P 500. But you're going to have stocks that are down, so you're adding up all these positives and negatives. It's just you're gonna do the math that way, and which I don't think is the right way to think about it. I think if you're talking about market breadth, you need to look at it on an absolute basis. And truthfully, the last couple weeks of March were really good breadth-wise. When Silicon Valley Bank news broke, that was not. That was really scary. Had some bad breath. Really, one really bad breath day, and then after that, it was more of a rotation for a couple weeks, and then it was a pretty broad rebound, which I view overall to be pretty positive. We'll see if it sticks. But yeah. So when you read something and somebody says, "Oh, only a couple stocks responsible for the gains in the market," either just just move on about your day and don't worry about it. It's one of those myths out there that doesn't really pan out.
But the makeup of that breath presumably looks very different, right? I mean, I've made that point before. This regional bank, in quotes, crisis basically killed the value trade, right? As money went out of value into growth, into tech. So the breath may have picked up, but presumably it's a different type of leadership underneath that.
Well, yeah, you're absolutely right. That's a different question of where within stocks you want to be. I think the takeaway from the regional banking crisis was, number one, banks are in a tough spot. Either they increase the money they're paying to depositors and kill their profits, or they risk losing those deposits, and then they have a solvency issue, or they depend on the Fed, or things like that. None of that's good. But more broadly, if banks are going to be lending less, or going to have higher standards, anybody who wants to go to the capital markets over the next couple of years may be doing so at a higher cost. And so what kind of companies would do well in that environment? Then now you're back to these growth names, right? You generate your own cash flow. I don't need to go to the capital markets. I'm fine. Whereas if somebody who does, they're gonna, it changes their valuation. So yeah. So on a relative basis, I think it did shake things up, and I think the market kind of had to come to grips with the idea that all these rate hikes do actually matter. It's not just on some number on a chart, or where you're showing bank reserves or size of the Fed balance sheet, or Fed funds rate, but actually for people running real businesses, and it's going to have impact. So I think for now, it did kind of kill the value trade. We'll see how long it lasts, but yeah, that was the. So again, it comes back down to the relative versus absolute. You have to make sure you know what your question is, and then where to dig for the data to get a good answer.
Yeah, that actually dovetails into sort of questions around lags, right? So as the regional bank headlines were coming out, there were a lot of people panicking, saying this is like 2008. They obviously stepped in, the policymakers, and secured the depositors. And now the counter argument is, well, when you have shocks like this, there's a lag on the system, so we haven't really quite seen sort of what all this is ultimately going to mean in terms of credit contraction, loan availability, so on and so forth. My response to that is, while I believe there's an element of truth to that, the lag can't be that long. I mean, markets are still presumably somewhat efficient. What's your sense of the sort of lagged effect of what's happened in March on the broader economy? Is this just, is this finished? Is this done? Are we going to see some secondary, tertiary lagged impacts on other sectors of the economy? I mean, you're starting to see it with some of these reports on loan availability, but what are your thoughts on that end?
Yeah, I don't want to kind of sound like on the one hand, other hand economist here, but let's go through a quick thought process. So let's say banks do cut back on lending; they tighten lending standards quite a bit, uh, and you'll see that in the new loan data, and that no doubt will have an impact on the economy, and no doubt, I mean that's really how generally recessions work. The Fed raises rates to the point where banks don't want to lend as much, and fewer people get loans, and there's less spending, and then you get a contraction. That's a business cycle. But somebody who got a loan a few months ago, they're okay for a while. Now they may change some of their behavior because they're looking ahead, going, well, when this loan comes due, what's it going to be like for the next round of funding? But there is somewhat of a lag on when it actually hits the real economy. Now, is that then there's a question of what about when does it hit the financial markets like a stock market, because we're all forward thinking, right? And we're going to notice this. And so if you say you look at um, how the market performs around the last Fed rate hike, usually the market doesn't do that well. The S&P's down 5.5% 6 months after the last hike on average. So the Fed's done. Well, they kind of usually because something broke or the economy's not doing well. That's why they're done. And stocks tend to not do well. Now, if you look at the more recent history, actually, stocks have done pretty well, up 4 out of the last 5 times 6 months later, and by double digits those 4 times. Now, you look at then you get an individual case. So you say, all right, well, 94, 95, okay, that was the gold standard. They actually pulled off the soft landing. 2018, the market rallied really strongly. Well, that's because Powell was new to the job and kind of made in hindsight, a policy mistake, tightened too much. The market tried to scream at him, you're going too quickly. And finally he listened and the market rebounded. In 1989 and 2006, yeah, the Fed broke something. You had the saving loan crisis in the early 90s, and you had, of course, the financial crisis in 2008. It's just that they did stop, and it took a while for the economy to actually go into recession and the stock market to actually peak out in those cases. And then the fifth case was 2000, where the Fed was done and the market had already peaked. The economy didn't go to recession for several more months, but the stock market had already peaked. So yeah. So I do think there's something to economically. There's a lag in terms of the markets. That's going to depend on investor sentiment and kind of where you are at that point in the cycle. So what I think can happen now is I do think there's a window here for the market to do well for a little while longer, partly because we had that bear market last year, but we are kind of on borrowed time. Eventually the recession is going to come in, the market's going to price that in. So I would view it certainly as a trade opportunity, not a set it and forget it multi-year bull market ahead of us.
Speaking about investor sentiment, and I know you want to talk about this, and it's an observation I myself have made. It seems like the question of is the crowd overly optimistic or overly pessimistic will change depending upon who you're asking, independent of the day, right?
Yeah.
So nobody
Yeah.
ever really there seemingly is never consensus. I'll put out a tweet that's in quotes bearish, and then somebody will say, "Well, on my timeline it's nothing but other bears." Then a day later I'll put out something that looks very bullish and say, "Oh, my time is all bullish." and it's like this is all algo driven and it's all anecdotal, but I am curious, just since you mentioned, kind of a quantitative focus from a strategist perspective, how the hell do you even know what the sentiment really is? I mean, polls are one thing, positioning is another, and then algos throwing at you whatever you want to see is a whole another dynamic that skews the thinking around this.
Yeah. Yeah. So this is where I'll shoot our own horn here, and hopefully, it won't come off as too much of an advertisement, because I really do believe it. This is where our quantitative objective approach comes into play. I'll put our data up against anybody, and our process up against anybody. And so what we've done is we've created some sentiment composites where we combine that information. Take the polls of individual investors, institutional investors, but also market drive gauges like the VIX, like call ratios. You put it together, and you can get a sense of where things are. Now, what that may mean is you can say, well, overall sentiment is, for example, sentiment's pretty bullish. Well, you may find a segment that's bearish, but overall it's bullish. But what we've seen over the past year is that there's pretty pervasive pessimism. I think it's because the Fed was talking about possibility of recession for so long. I mean, can you imagine Bernanke or Yellen or Greenspan kind of go in a tightening cycle like Powell has? Well, if it created a recession, so be it. I mean, we haven't heard that since Volcker. Um, so normally the market peaks about 7 months after the first hike. Well, this time we peaked 2 months before the first hike. Okay, so as the Fed started tightening, we were already well into this, and so our sentiment composite was in its pessimism zone from early April of 22 all the way through early February of 23. And that's the second longest it's ever been in that pessimism zone. The only time longer was 08, 09. So if last year felt bad, because it was, we saw it, in 2002, 2003, and 2011 and 12 were also long periods of pessimism. When you left pessimism, you were, so the market's kind of climbing the wall of worry. You were in a bull market every time. Only three examples. Again, this is 2003, 2009, and 2012. Only three cases, but you were in a bull market every time. And so when we left pessimism in early February this year, we thought, maybe this rally has more legs. This is not the same thing as those kind of head fake bear rallies we saw, say, in March and June of 2022. So I think overall, there has been pretty pervasive pessimism, but yeah, you do need to take a holistic approach, and this is where I do enjoy Twitter. I think the FinTwit community is pretty good for getting good information. You'd have to kind of block the haters or whatever, but I think one of the things you have to be careful with on Twitter is it's by design sound bites, and so if you see one chart, okay, great, but what is it? Is this really holistic, or is this just one thing? So yeah, so that's kind of how I think about it.
But it's interesting, right? Because there's two kind of contrarian arguments there, right? One is the length of time that data is bearish should make you contrarian, right? And the magnitude of the bearishness obviously should make you contrarian. I do wonder though if last year was maybe an exception around the idea that the length of negativity is a contrarian tell only from the standpoint that most investors couldn't do anything about it. They might have been bearish, but their expression of negativity on stocks was matched by the performance that was terrible of bonds, right, as a means of countering it. So positioning wise, I'm going to make the assumption that there was a pretty big disconnect between the narrative and the sentiment versus what people were actually doing about it.
Well, yeah, I think that was a frustration for a lot of people, right? There was no place to hide. First year ever, stocks and bonds were down at least 10%, all the way back to the 20s. So, cash was really your only option. Well, and commodities for the first part of the year last year did well, but yeah. So what does that mean? Were people positioned as negatively, say, as in 2009? I think by some measures, if you could see that, but by some other ones, maybe not. So for example, the Fed flow of funds data, it's quarterly, it's slower moving. but you look at households, their equities as a percentage of total assets came down a little bit. But really, what I think what it showed is, as you implied, it really reflected the fact that their equity portfolio went down, not necessarily that they that they sold. So I think maybe some long term buy and holders who probably did still hold on some last year. But there's probably something to that. But as I talked about before, you got to take it all, as in a holistic view. And okay, so maybe we didn't get the full out get me out, I can't take it anymore type of pessimism, but we certainly got hedge funds, traders, even kind of long only asset managers, they were really negatively positioned. So any sort of good news is probably going to lift the market, just because if they took off some of those negative positions. So yeah, I think it's a good question to kind of illustrate. There's a lot of nuance when you're talking about anything really, but certainly when you're talking about investor sentiment, because there's so many different groups.
Yeah, and actually, that point, which relates to the question of capitulation, I think is interesting. I mean, you had an elevated VIX level last year, but you never had the real VIX spike, the sort of bear market ending with a bang type of dynamic. Are there other examples in history where bear markets end quietly? Because I'm going to argue that that was a pretty quiet end to the bear market. If that was it, you never really had that real vol spike, that credit event, if that's the case.
Well, okay, so I think if you're talking about economically, clearly we haven't had a recession yet. So I guess you had
Right,
two
it's
negative
really
quarters
that
of
this year.
GDP.
Exactly right. Right. Okay.
Yeah. So that yeah, I think that the VIX thing is a good example of why you don't hang your hat on one indicator. And so I think if you were to turn on certain channels on TV, there'd be people were screaming VIX isn't high enough, VIX isn't high enough. Meanwhile, you're kind of missing the other stuff. In fact, we have what we call a bottom watch report. We have like 12 different indicators we watch for, and VIX is one of them. The VIX never got close, but the other ones did. So that's why you want to take a holistic approach. And so here's what we saw happening last year. In the first half of the year in 2022, every time the market declined, you got more stocks making new lows. Okay. And you saw really negative declining volume, advancing volume. So you saw take all the stocks went down the day. What's their total volume? All the stocks went up the day. What's their volume? That ratio gets above 10-1. That's a bad day. And we got 10-1, 40-1. We got a lot of really extreme readings. And it all kind of crescendoed in June when you had that really bad CPI report, and then the Fed leaked the 75 basis point hike. And I think we had like over 40% of stocks in a given day were making 1-year lows. I mean, that's really bad. And then you got the relief rally in August, and the market came down. S&P, Dow, NASDAQ made new lows, but we had fewer stocks making 1-year new lows. The declining advancing volume was not nearly as extreme. And that's what we call a nice positive divergence. In fact, if you were to look at kind of panic lows and then the retest, on average, on the retest, the Dow breaks the low by 3.9%. And if you look at the June low and the September 30th low in the Dow, it was exactly 3.9% lower. So it's probably coincidence it was that precise, but that's a good first step, positive divergence. And then we got another rally, came down in December. December was terrible, a lot of tax loss selling and things like that. But the percentage of stocks making new lows was nowhere nearly as bad. So I think we did go through a good technical bottoming process. I'd always like there to be so maybe everything line up. But I think we had enough of a lineup to say this rally could last. This could be a pretty good rally. And like I was talking about earlier, I don't know how long this thing goes, and ultimately the Fed probably cause a recession, and then we're gonna deal with all those demons at that point. But I saw quite a bit of evidence the latter half of last year that we had gone through somewhat of a bottoming process, and there was some stuff that said you had panics. I mean, keep in mind we had the first land war in Europe in 75 years, and some of the worst breath days were right after that. So that was a panic at that point.
No, I think that's a very good point. A lot of the pain was very front loaded, and then you can argue was sort of a lot of chop. Now, there's another aspect of this dynamic which I think is underappreciated, which is that you can argue there's almost an asynchronous nature to cycles even within the stock market. I mean, speaking about small caps peaked in February of 2021, except for like a momentary blip where it crossed over late 2021 and then kind of broke. But really kind of going sideways. Breadth started weakening around then. So a lot of people will say the bear market started in 2022. I think from a breadth perspective, it started way before that. Um,
Yeah.
I wonder how you think about sort of just things not sort of co-moving as well as they used to. I mean, it does look like there's two very different markets, right? Between large caps, small caps. That idea that the market kind of a rising tide lifts all boats. It doesn't seem to be as strong as it maybe was pre-COVID still.
Yeah, well, I think that was actually a pretty interesting tell. The market was in trouble because you're right. Throughout the latter part of 21, that was a good example of a narrowing market. Where in the first half of 21, we were like, breadth looks pretty good still. Russell, small caps on acting as well, but breadth's absolute still holding okay. By the time I got like the end of the third quarter and the fourth quarter of 21, and you couldn't really say that anymore. And so that was a tell. And sometimes the lead times vary, which makes this tricky, right? And that's just the stuff we've tried to analyze quantitatively and haven't really come up with great answers all the time. It's like, okay, this happens, then what's the lead time? And it's not always super clear or consistent. So, for example, the average stock in the U.S. stock market peaked in April of 1998. Okay, and we had a brief bear market in the summer of 98 around long-term capital management, Russian ruble crisis. And then Greenspan got all the bankers in the room and said, you need to fix this. And the Fed provided some liquidity. And then you got the, boom, the roaring, late 98 all through 1999. And also the Fed was pumping money in the economy because we had word about Y2K. People thought they weren't going to get money out of their ATM machines. And so they put all this money in the system. And so, but it just funneled into so few stocks, and that's how you got the final leg of the internet bubble. And then the Fed started taking the money out.
Professor, not to interrupt, but that's an interesting parallel around some of these profitless tech companies, right? Because I'm with you. When Greenspan stepped in to try to front run Y2K, it's argued that was what caused the blow off, into the March 2020 in tech.
Yeah, exactly. Yeah. So you look back, well, the average stock had been in a bear market for almost 2 years by the time you got the March 2000 peak in the cap weighted indices. But that was a long time to wait. If you said, well, the average stock's going down, I'm going to sell. Okay, well, NASDAQ was up almost 100% in 1999. That's a great way to get fired if you're managing money. But yeah, and I should kind of bring that back to today. And free money or very low cost of money is going to keep a lot of companies around, and then you start putting a price on it. There's going to be some companies that probably need to update their business plan, maybe need to get acquired, or maybe shouldn't be in business. Those sort of things, and that's what was going on in 21. Yeah, so you had some of the mega cap growth stocks doing well. Like if you look, for example, the Russell 1000 growth value ratio, cap weighted indices, large cap growth was still doing pretty well. If you look at the Russell 2000 growth versus value, small cap growth was getting crushed because that's where a lot of those small unprofitable growth companies were. So there were some parallels with the 90s, late 90s, and what was happening in 21 growing to early 22.
Speaking about parallels, I put a lot of tweets out, and I have this framework as far as how I think the year plays out. I've said I think we're in a year where broadly there's a dynamic for, in quotes, a melt up. That you might have maybe the start of correction very short term. I think maybe next week. I know some people think I'm crazy in saying that, but I'm using intermarket relationships to make that conclusion. But that you still have kind of a broader positive backdrop, which I think you'd probably agree with for the bulls. But I keep going back to, I think there is a credit event out there. And some people, when I say that, think I'm trying to talk through multiple sides of my mouth, that I'm trying to have it always all directions. There is a parallel in history which I don't think is that far fetched, which is 1987. 1987, everyone talks about the crash, but people forget that the Dow was up over 30% prior to the crash of 87. You had a very strong pre-election year move before a tail event, right? And then a Fed pivot. All that happened within 1987, you had a melt up, a crash, and a Fed pivot, right? All in the same year. I wonder if you think we could maybe have a similar sequence, not necessarily that you have a crash, but that you could have some absolutely wild moves this year beyond what the Bulls and Bears imagine. If these lags, to your point, suddenly become a reality with what the Fed's done last year.
Yeah. So let me, kind of walk through what we're thinking. And, this is, again, not a very un-NDR way to do things. We're going to have our models indicators, and when they change, we change. But it's very possible the Fed hikes on May 3rd, and then they hit the pause button because inflation's coming down. They are looking at the tightening lending standards. Maybe the private sector is doing, the last couple hikes for them. And then that could maybe trigger a rally where investors are thinking that perhaps they could achieve the soft landing. But what happens if we get to end of the third quarter, into the fourth quarter, and unemployment rate's still around 4%, but inflation has started to tick back higher? Because once you get rid of the year, there's better year-over-year comparisons we're getting now, plus later, we're also going to get some, still getting some of the post-COVID supply chain positives, and then we're going to get the owner's equivalent rent looking better for several months. You got to get past that, and you're going to be left with inflation well above the 2% target. So let's say, just throw out a number: 4% inflation, 4% unemployment. What's the Fed going to do? A hike. And maybe that's when they trigger some of these credit events where, you'd like to think banks are taking the necessary steps at this moment, and hopefully most of them are, but it just takes a few to not do it, to cause a problem. And so maybe that's when it happens. And then, does it have to? I know what you're saying. When you're talking about 87, I'm going to put words in your mouth, but I don't think you're saying October of 2023 is going to be another 25% decline. But yeah, are we setting up for a bigger decline once the recession actually hits? I think there's very much a risk of that happening. And do you get like a relief rally along the way? Yeah, I think so. Especially if, say, other central banks, kind of add liquidity, so you kind of get a kind of global QE, so you kind of like pumping up the balloon a little bit in the summer as the Fed kind of pauses. All that's a possibility.
Yeah, and I mean, to be clear, it's not me kind of fear mongering around a Black Monday type of scenario, but my point is that tail events happen when nobody's paying attention, right? And one way to talk about sentiment, right, to lull people into the idea that you don't have a tail event is if you have an enormous move beforehand, making it seem like the market's only going to go up, that inflation's finished, and whatever the narrative would be at that moment in time. But since you mentioned the Fed pause, how does that interplay with the ECB and other central banks? There's the old adage that the Fed is the world central bank for a reason, right? That the Fed leads and everyone else largely follows. Although in this cycle, as I've said before, Brazil was really the one that moved first on raising the Selic. But how do you think things play out with Europe? I have to tell you, it's remarkable to me that European financial stocks are outperforming U.S. financial stocks. Uh, Normally, in a crisis, you'd think it'd be quite the opposite.
Yeah. So, well, first of all, I think you're right. You say, all right, the most responsible central bank in the world is Brazil. I think, oh boy, you know, we're we're in trouble. But yeah. So I was actually in Europe. I guess a couple months ago now, and they were all shocked at how well they'd managed the past year. And I think there's an element to sentiment in looking at the performance of European financials, where I think that the thought was, okay, well, Europe definitely is going to have a severe recession. It's a price they're willing to pay, for the geopolitical risks that they're facing. And in reality, their policy and their economies proved to be pretty dynamic. Out. Don't I don't think the ESG crowd's going to be super excited about what's going on, because they basically start burning a bunch of coal to make up for the natural gas. But yeah, so I think there's something there. But to kind of bring it to central banks, I wouldn't be surprised if the ECB doesn't kind of get in line a little bit with the Fed, especially now that they feel like, not that what's going on in Ukraine that's by no means over, but they kind of have a handle on it a little bit more. And I think there's some visibility on, what's going to happen with the energy and commodity markets, that maybe you could see potentially a little bit more synchronized global central bank policy would be my general assumption.
Yeah, I think that makes quite a bit of sense. I'm curious. You're dealing with a lot of institutional clients, and obviously putting out a lot of research. What are some of the things that you're coming across as major concerns? I mean, aside from the standard, what's the Fed going to do, inflation? What else are you hearing from sort of the larger money as far as concerns or areas that they're trying to focus on?
Yeah, I think one thing that's come across clearly is if you were to look at consensus estimates for S&P 500 earnings, no one thinks these are anything close to reality. I mean, if we look for Q1 earnings, consensus is calling for about 2% growth year over year, single quarter. And okay, fine. I think that they've brought those numbers down. They're on 8% in December. So, but then if you start looking at Q3, Q4, it's like 12, 15% each quarter. And what about the U.S. economy or global economy makes you think that they're going to be able to do that? And so those numbers are going to come down. And how does the market digest that? It's possible the market just says, okay, thank goodness, nobody believed those numbers anyway. But historically, when there's been some pretty steep downward earnings revisions, that tends to be a hiccup for the market. So when does it happen? Does it happen in the next few weeks, or do they say, okay, yeah, we already lowered the Q1 numbers, we hit them, that's good, but we got to take the rest of the year down? I think that may actually be a contrarian, a bullish thing, that we kind of get that out of the way. Where although most of the time, what they do is they kick the can down the road. They may take Q2 down, but they'll leave Q3, Q4 down. And usually what happens is, part of the reason why September and early October tend to be seasonally weak is that at that point, companies kind of have to throw in the towel and say, we can't, there's no more time to push the earnings for the full calendar year or fiscal year, down anymore. We gotta come up with being honest about how this is going to go, and we're not going to hit our numbers. So I think that's something that is kind of out there as a known unknown. We talked about, obviously, that there's a lot of concerns about interest rates and the Fed. I've gotten some more some comments about who all the losers of higher rates for longer are going to be, and one of them that keeps coming up is private equity. What do they do as these other funding cycles move on? How are they going to handle it? Do they just require a higher rate of return, or are they just going to kind of tighten their standards? And that's become such an important part of the economy. Call it the broader shadow banking system. Such an important part of the economy. What does all that mean? And it's harder to get a handle on that than even some of the some of these banks, which are all the information all has to be out there. It's hard to digest, but at least it's out there. Whereas the shadow banking system, you just don't know.
What about on the commercial real estate side, or home value side of things? There's certainly off into it that gets a lot of attention and starting to get more and more in the traditional media headlines. But are you hearing some concerns around that from the larger client you have?
Yeah, not as much, but I'll be honest. I think that's a function of my role. I don't cover that a whole lot, so they're not going to come to me for that. Um, but yeah, on the residential side, my opinion is you're going to see more people stuck in homes. So the problem would be, if you're a millennial and you have you're in your first home, uh, then okay, that's fine. But let's say you have some kids and you need to expand, then what? And you know, you're kind of stuck for a while. So that's I think going to be the challenge. And then if you get in the commercial side, again, these are slower moving asset classes, but eventually I think that's gonna become a bigger issue for on the commercial side. Now there's a lot of levers that commercial real estate can pull in terms of you have long terms on loans, and so if the value has gone up over say the last 10 years, when it comes times to refinance, your loan to value ratio maybe not won't look as bad as you at first blush, and you're just looking at the rise in interest rates. Also, you think about, well, the worst part of commercial real estate, where you go to look at Manhattan, look at San Francisco. Yeah, those may be problematic, but I live in Florida. Commercial real estate down here is pretty tight. And so there's that too. There's some diversification there, but yeah, as somebody said to me, a lot of times, you look back and, the crisis is hiding in plain sight. And, this time it seems like commercial real estate is probably the crisis, that, that at some point we're going to have to deal with. It's a question of when.
Yeah, I've used that line before. Nothing matters until it matters, and then when it matters, it's the only thing that matters, right? So people know it's out there. Nobody seems to care about it, but then when they do care about it, suddenly that's where all the volatility ends up, coming from, right? For public markets, it's always hard to obviously time that, and maybe sentiment can help a little bit on that end. Maybe just for the last few minutes here, Ed. Again, everybody, please make sure you follow Ed Clissold here on Twitter. Just talk a little bit more on maybe just the sector side of the market. Where are there really attractive valuations? Are there certain sleeper industries that you're paying attention to that could really have a nice move? I mean, personally, I think this is probably a good year for healthcare. I say that kind of tongue in cheek because inflation is stressful, and stress is a big reason for people going to the hospital. But what are your thoughts on that end?
Yeah. So okay. So in terms of healthcare, or we had been underweight. We took it up to market weight. One of the reasons we didn't like it was that as inflation was high, usually healthcare has good pricing power compared to a lot of other sectors, but with inflation high in lots of other areas, it really didn't. But as inflation comes down, that's a net positive for healthcare. But yeah, so our underweight, right? Our single underweight at the moment is real estate. So the kind of what we talked about with commercial real estate, applies on the real estate sector, which is mostly REITs. But and our overweight right now on a tactical basis is technology. That's not where we had been. We had been in the more cyclical value areas where we were overweight energy and materials, but as those technically broke down, we rotated out of them. So I wouldn't be surprised if we do get a good rally here. Some of those cyclical sectors don't catch a bid, and then as the economy rolls over, I think the knee-jerk reaction is going to be to go into these mega cap growth-ish names, the fan mag stocks, which tech is the biggest sector that has those, but also some consumer discretionary and communication services. But if this is, this is not going. The next recession is not going to be like the 2020 recession. which was quick, and everyone's stuck at home. And so, what you ever bought, you bought iPads and computers, and you bought everything off Amazon. That's not how the next one's likely going to go. And so, you're going to probably want to look at your traditional defensive sectors: utilities, staples, healthcare. Are the three that you'd focus on during an economic contraction. So I think on a tactical rally, it's okay to get cyclical, but look for the tried and true recession plays, as if the economy does fall into recession, and that would be again utility staples and healthcare later on in the year.
I think that's a good place to wrap this Twitter space up. I will say also, part of that obviously is not equities, but would be long duration treasuries, which everyone seems to think is no longer going to be a hedge, but that's typically how hedging behavior tends to come back, the sort of flight to safety dynamic there. But with all that said, thank everybody for joining. I am very appreciative of those that keep supporting the effort. I have done 5 Twitter spaces back to back. I am going to get a drink of water, get some lunch, and then hopefully be back tomorrow. So thank you, Ed. Really do appreciate it.
No, thank you. Appreciate it. The opportunity to come talk.
Cheers, everybody.